whether you bought gold at 4,700, 4,200, or 5,500, I don't think that'll be your biggest concern. You'll be so glad you did. Some of them come from banks. Some of them come from hedge funds. Some of them don't talk about gold publicly, but they understand history and math, and they're not putting 100% in gold, but they know that gold is going to hold its value. It's going to buy more down the road than any paper currency. And that doesn't mean that gold or silver go up in a straight line or that there won't be pullbacks. We go from the incremental, as Ronnie Sturfula's fund is called, to the exponential. We go from that percolating disaster to an explosion. And what I looked at in that article, I was looking particularly at the oil prices and the oil shocks and the oil deficits as a potential percolating volcano that becomes explosive. And what I was trying to warn is, if we look at prior deficits, if we look at prior oil deficits and what that does to the supply chain, what that does to inflation, to oil prices, to currencies, and to markets, we are at a Mount St. Helens type of moment right now if something isn't resolved quickly.
Since 2000, all fiat currencies have dropped over 90% since 2000. So if you're holding just fiat currency relative to gold, that is the proof of what you're talking about here. And so the issue is that most people have not been educated and trained and taught to understand that gold is money and everything else is a derivative of that, and that it's sound, and to measure everything versus gold. They're doing it versus the US dollar because that's how they've been trained and taught their whole life.
Yeah, and that's why I'm not trying to be critical. Up until my 40s, didn't understand gold. I was that hedge fund dragon slayer, lottery ticket winner on the NASDAQ. I didn't understand sound money. I thought X amount of dollars meant you had wealth. When Egon von Greyer's and others taught me that's not wealth at all. That's paper wealth, and that's transitory. And, certainly Ronnie, who's brilliant, and I love the name of his fund, Incrementum, because he's really talking about incremental destruction, which becomes exponential now. But the education gap, I think, in gold is slowly kind of compressing. More and more people are now asking this question, not just because gold hit such all-time highs in 2025. That certainly got on the radar when you see UBS and JP Morgan and Morgan Stanley and Goldman Sachs openly bullish on gold with higher price targets in some cases than we even have for this year. That's a game changer. When people say, well, that's just a headline of a bubble. Again, the fundamentals have to be remembered here.
What changed was not gold itself, but the institutions that once dismissed it now quietly validating it. As Matthew Piepenburg points out here, when major banks suddenly issue bullish gold targets after years of skepticism, investors should ask why that shift arrives only after a historic move. Wall Street often waits until an asset is already repriced before calling it credible for the public. Since 2000, most currencies have steadily lost purchasing power, yet many portfolios are still measured in nominal gains instead of real wealth. Next, Matthew Piepenburg discusses why the dollar itself may be giving investors a dangerously false benchmark.
Gold is not rising, the dollar is falling. People are starting to figure that out. There are a lot of kooks and quacks in the gold space, but most of those who've been in it for decades, certainly like Ronnie and certainly like Egon or Frank Justra and others who understand the equity side or the actual metal side, we've been kind of left behind, ignored by Wall Street. I certainly ignored it at Wall Street. It was deliberately downplayed by the banks. It was deliberately downplayed by the media. It was deliberately downplayed in business schools. But those who've had that conviction for decades, like Egon and others, and myself for the last 10 years, we haven't been crying wolf. We've been trying to teach history, not just economics. And Ronnie's a classic example of that. The dollar, since 1971, has lost 99 of its purchasing powers versus gold. When Nixon decoupled from gold, the Fed chair and other congressmen were doing the tours of the Senate, and experts came in that said, not only will the decoupling of the dollar make the dollar stronger, it will make gold weaker. And not only that, they said it would be temporary. All of those things were lies. Gold's up 8,000% since 1971. The dollar's down 99%. And decoupling from gold was not temporary. So again, trusting in the experts, the guys in the suits with the fancy degrees and the political might behind them, has been a mistake. I don't fault people for trusting their elected officials or their fiduciaries in DC. It's hard to realize, to swallow that red pill and realize that you're being led by an island of misfit toys. I joke, It's the dumbest kids in the class from high school who are now in charge of the school. And that's a scary realization when you see that. It takes years to see that. It takes critical thinking, some cynicism. But Ronnie, Egon, myself, you, many others are starting to understand this more. It's not a case for gold as being the salvation of all things. It's a case for understanding how debt, mismanaged as it has been, and all the tricks and phrases and euphemisms and economic terms, and all the short-sighted opportunism in DC and Wall Street over the decade since 1971 has incrementally destroyed paper money in general and the US dollar in particular. This is not fable, but fact. This is not gold bug sensationalism. This is what we're living through right now. And it's very sad, very sad.
It is very sad. And hopefully what you just said about more and more people are asking, more and more people are getting educated. I'm hoping that is the case. But, you know, there are still so many analysts and investors alike out there that they're out there saying right now, gold has done its job. Gold was a geopolitical hedge. The run-up happened because the war was coming, and now it's largely done. It's behind us, and because of that, gold isn't going to be moving anymore. There are some billionaire hedge fund leaders that I have heard say this very thing, that gold has done its job. It did what it was supposed to do, but now its run is over.
The real story is not a stronger gold market, but a weaker currency system hiding in plain sight. As Matthew Piepenburg points out here, the dollar has lost roughly 99% of its value against gold since 1971, yet most investors still judge wealth in dollars alone. That creates a dangerous illusion because nominal portfolio gains can mask declining purchasing power underneath. Many analysts still frame gold as a temporary crisis hedge, even while debt expansion and monetary dilution remain structurally unresolved. Next, Matthew Piepenburg talks about the deeper force that may keep driving gold long after the headlines move on.
Now, there's others, as you alluded to in the very, very beginning, that geopolitical issues or headlines, that's not what moves gold. In fact, gold is moved by money supply. Money supply is set to explode. More money units leads to the decay of each unit in and of themselves. And therefore, gold has a much, much longer way to go. Would you just simplify for those tuning in? You know, I'm pretty sure I know which side of the aisle you're on, but simplify for those moving in. What really moves gold? You know, what is gold a reflection of in truth? And what are you expecting that reflection to bear out here in the coming months and even beyond?
The most simplest thing to say is gold is more honest than politicians, and that may sound hokey. Gold is real money. Paper money is political money, and political money is always debased for political reasons. And so it's like Gresham's law, you know, and we've seen this throughout history. Eventually, politicians, again, whether they're monarchs or whether they're, you know, Democrats or Republicans or whether they're autocrats, whether they're the Romans of the denarius in 200 AD or whether that's Yugoslavia in the 90s or whether it's a banana republic in South America or whether it's Weimar in the extreme cases of Zimbabwe. Even the home of the world reserve currency can't get away with expanding its money supply backed by nothing without diluting its currency. There's no case in history for it, and the U.S. is no exception. This is throughout history, and as Gresham said, you'll get to a point when there's two forms of money or currency at the same time.
Headlines often move sentiment for a day, but liquidity usually decides where markets go for years. As Matthew Piepenburg points out here, gold tends to respond less to war headlines and more to expanding money supply that quietly reduces each currency unit's value. Investors sometimes mistake geopolitical fear for the cause when it may only accelerate an existing monetary trend already in motion. History repeatedly shows that governments facing debt pressure choose currency dilution before fiscal discipline because it is politically easier. Next, Matthew Piepenburg unravels what happens when people begin choosing real money over political money.
When you have paper currency, which is political, and physical gold, which is real money, at some point, people will start to save more in the real money and spend in the bad money. And as Adolf Thiers said in the 19th century, eventually they'll stop saving or even spending in paper money altogether. They'll just hold gold. That's what central banks have been doing since 2014, and that expanded dramatically in 2022. I'm not a fan of the central banks or the BIS, quite the opposite. But look what they're doing, not what they're saying. They're following Gresham's law. They're saving in something that holds its value and spending in fiat. Eventually, gold becomes more important, which is why I do not think we've hit a ceiling by any means in gold. By the way, when you're measuring gold going from 5,000 to 7,000 to 10,000, never, by the way, in a straight line. Of course not. It will, in my opinion, in all of our opinion of Von Geertz and many others. But, you know, when you're measuring that in dollars or euros or pesos or Swiss francs, you're still measuring in a paper currency that's melting. You know, what you should be measuring is how many acres of land, how many barrels of oil, how many chickens can you buy with an ounce, a gram, or a bar of gold, as opposed to how many dollars are you getting for it, because you're measuring it with something that's losing value all the time. It's not, again, that gold is getting more valuable.
The quiet signal is not what central banks say about stability, but what they keep buying behind closed doors. As Matthew Piepenburg points out here, official sector gold buying accelerated after 2022, suggesting institutions trust hard assets more than their own policy language. That matters because central banks rarely reposition reserves this aggressively without seeing long-term currency stress ahead. Investors who only watch the dollar price may miss the deeper question of what gold can still purchase in real terms. Next, Matthew Piepenburg discusses why measuring wealth in paper currency can distort the entire investment picture.
It's the monetary paper money you're measuring it is getting weaker. Gold has been real money for millennia. Everyone knows that. Central banks are seeing this. Pre-1971, it was central banks, it was 70% of their reserves. Today, it's only 30%. It will at least get to 50%. So we're by no means at a high or a peak gold price now. It will get to at least 50%. It is becoming politically the de facto primary reserve asset. I mean, the FX reserve currency, the dollar is going down and gold is going up. Central bank gold stacking is up 5x since 2022 when we weaponize it. For the last 15 months, central banks continue to net buy gold. So no, it is not a ceiling in gold. And yes, I have a bias. And yes, you could argue I'm saying that so you can become a client. But no, I'm far more of a teacher now than just an executive selling his book. People have to understand what happens when the money supply expands. The M2 supply, the ratio of M2 to the gold price now is at 4.6. It was at 2.5 in the 80s. We can double from here and that would still be normal. And guys like Luke Groman and others in my office talk about the market price of the U.S. official gold market price and the ratio to foreign held U.S. treasuries. It's a very low percentage right now. Gold would have to triple to get to prior percentages. Those are just technical reasons. Mm-hmm. But again, the fundamentals, keep it simple. Keep the lighthouse simple.
The bigger signal is not the gold price, but who is quietly accumulating it. As Matthew Piepenburg points out here, central banks have increased gold purchases nearly fivefold since 2022, while reducing reliance on dollar reserves. That matters because reserve managers rarely reposition this aggressively, unless they see structural stress in the currency system ahead. The M2 to gold ratio, sitting near 4.6 versus 2.5 in the 1980s, suggests gold may still be undervalued against expanding liquidity. Next, Matthew Piepenburg discusses why sophisticated investors treat gold as long-term protection rather than a short-term trade.
Amongst all the fog, all the statistics, all the headlines, from COMEX to the bank failures to central banks, gold just holds its value more than melting paper dollars or paper euros or paper yen or paper Swiss francs. And it's not that gold goes to 1 million like Bitcoin people have argued for Bitcoin. It's just that gold is going to hold its value better than any other paper currency. It's going to be a lot less volatile than in crypto money. Again, that's a whole other rabbit hole, and I don't need to get into that. But we have clients from 90 countries, and they're pretty sophisticated. Our minimums are very high. They're very smart people who've made and earned their money, inherited their money, or consolidated their money. And you'd be surprised who some of these people are. Some of them come from banks. Some of them come from hedge funds. Some of them don't talk about gold publicly. But they understand history and math, and they're not putting 100% in gold, but they know that gold is going to hold its value. It's going to buy more down the road than any paper currency. And that doesn't mean that gold or silver go up in a straight line, or that there won't be pullbacks, and that you can still try to speculate when's the best time to buy. But 20 years from now, whether you bought gold at 4,700, 4,200, or 5,500, I don't think that'll be your biggest concern. You'll be so glad you did.
Most investors still confuse excitement with preservation, and that distinction matters now. As Matthew Piepenburg points out here, many wealthy investors are not chasing gold because they expect drama, but because they expect stability against weakening currencies. That is a very different mindset from speculative buying, because the goal is preserving purchasing power over decades, not outperforming next quarter. Gold can still correct sharply, but long-term holders often care more about what their savings can buy later than temporary price swings. Next, Matthew Piepenburg talks about the deeper financial stress that could make that discipline look increasingly wise.
Because gold will be meaningfully higher, only because the paper money will be meaningfully weaker.
Yeah. Okay. So, Matt, you recently wrote an article titled Gold versus an Erupting Financial Volcano. In it, you pretty much stated a warning that few realize just how quickly observation can suddenly turn to extreme danger.
Yeah.
Would you kind of explain what you mean by that warning, and how close are we to this happening?
Yeah, I used in that article an example of a really brilliant volcanologist, a guy named David Johnson, who was watching Mount St. Helens. He came out for one day to look at Mount St. Helens. He's been tracking the dangers and the risks of Mount St. Helens. And he meant well, and he was a very bright individual, and he was watching this eruption, and people were kind of joking about it or not taking it seriously. And sadly, he was 10 kilometers away from Mount St. Helens when it suddenly just erupted, and his body was never found. He was swept away. And the analogy I was making is, a lot of us have been observing the volcano of a global financial system that's broken at so many levels and ready to explode. It doesn't have to happen overnight. It can be death by 1,000 cuts. But at some point, we go from the incremental, as Ronnie Sturfula's fund is called, to the exponential. We go from that percolating disaster to an explosion. And what I looked at in that article, I was looking particularly at the oil prices and the oil shocks and the oil deficits as a potential percolating volcano that becomes explosive.
Financial stress often looks manageable right before it stops being manageable at all. As Matthew Piepenburg points out here, systemic risk rarely announces itself with one dramatic event, because it usually builds quietly through debt, liquidity strain, and energy shocks. Investors often dismiss slow warning signs because markets can remain calm long after the foundation has started cracking underneath. The danger is that portfolio complacency can survive right until volatility suddenly reprices multiple assets at once. Next, Matthew Piepenburg unravels which hard numbers suggest that slow pressure may now be turning into something far more serious.
And what I was trying to warn is, if we look at prior deficits, if we look at prior oil deficits and what that does to the supply chain, what that does to inflation, to oil prices, to currencies, and to markets, we are at a Mount St. Helens type of moment right now if something isn't resolved quickly. And I don't know if it will be, but the math of not just oil deficits, but the math of debt to GDP, the math of treasury yields when they get to 4.8 or 5% against $40 trillion debt, the math of what our employment data suggests and the disconnect between Main Street and Wall Street, these are objective empirical warning signs of a volcano percolating and could explode. I don't think we're ever going to solve our deficit or debt or currency problem. What worries me about this war, again, not an expert on war, don't know if it ends tomorrow, hopefully it does. If we keep playing this game with our foreign policy, with the oil markets, with the petrodollar, with puffing our chests without looking at the math of economics, this Mount St. Helens moment could sweep a lot of people away if they're not prepared. And I think gold is certainly one way to prepare. It's not the only way to prepare. Gold can't solve every problem, but it certainly can solve a financial problem. And that, Gary, was what the article was about, looking at the math of debt, oil deficits, in prior history. And I think a lot of people still have their head in the sand, or they feel they're too late, or that gold is too expensive, or they can't afford it, which I understand. But we are about to see an eruption. Even if peace was declared tomorrow, the delayed effects of this many weeks, with oil being denied so many countries and the supply chains being cut, and all the ripple effects of what oil and energy do. It's not just the oil price, the transportation of everything. I talked a little bit about fertilizer and how that affects agriculture and food. It's more than just a gold and oil discussion, but it's a massive financial discussion.
Sometimes the most dangerous market risk is the one still being treated as temporary. As Matthew Piepenburg points out here, Treasury yields near 5% against $40 trillion of debt create a refinancing burden that cannot be ignored indefinitely. Add tighter energy supply to that equation, and inflation pressure can reappear even while investors expect relief. Markets have been pricing resilience, but supply chains and sovereign debt math can quickly challenge that confidence.